Can you all hear me? Excellent. Good morning. Thank you everyone for making up bright and early. This is the disciplined and the really ambitious crowd, so thank you very much for putting in that effort. Like Peter said, this panel is really playing off of what Titus mentioned yesterday in his opening speech about the movement of people across borders, how that starts with certain groups and expands over time. But the other important thing that we need to consider is, of course, the capital that they are either bringing with them or moving ahead of them as they're still planning, their ability to move to places where they're treated best. That is enough, I think, to set the stage for the panel. I'd like to then ask my fellow panelists, starting here with Sven, to do just a quick introduction. What is it that you really focus on? Where are you living? I guess Peter already mentioned that, so maybe a quick fact about what makes you interesting on this panel.
So I'm German, and I left the country way earlier than before this entire movement started in '98 because I sensed trouble was coming down the road. And I'm now based in the Channel Islands, Guernsey, Jersey, Alderney. I have a fund management business in Guernsey, and I personally live in Sark. It's a place for safekeeping investments, for living a very free lifestyle. We are a quasi-libertarian society. I'm very excited to be back here again.
My name is Lara Moberg. I am from Sweden originally. I live in Fort Lauderdale, Florida, United States. And I have done extensive work on special economic zones, studied that a lot. I have a book on the topic. I have been focusing on cannabis the last few years, and I have a credit fund in that space focusing on the United States. And I'm also starting a wealth management firm.
Good morning, everyone. So Sam Roberts, Director at Cartwright, advising institutions, including pension schemes, corporate charities. And I'm coming at this more from a sort of portfolio construction, strategic point of view. As Peter said, we were the first, not just within Cartwright, but within the UK more generally, to add Bitcoin as a legitimate asset in our eyes that available to institutions.
Thank you very much, Sam. And I guess really echoing off of what you just mentioned there, I think the first question I'd like to ask, starting with Sam and then working our way back, is this concept of savings versus investment. Where I live in the United States, there's a pretty standard form recommendation. You should have 3 to 6 months worth of cash. As a United States citizen, it's all in US dollars. And then, everything above and beyond that, it might be in your 401k or your other sorts of tax advantaged accounts. It might just be in general brokerage accounts. But this is really something that's necessary because you don't want to keep too much of your money in savings over time. You want to put it into the stock market and see that appreciation over time. I'd love to know from your perspective, both personally as well as institutionally, how do you think about this question? What are the factors that you think about in terms of how much saving, how much investment? What is the difference between the two in terms of what you're doing, sort of in your own thinking as well as advising your clients?
So I'd say there'd be 3 sort of buckets or 3 areas in which you have money, what do you do with it? So the first one is spending and lifestyle. That's obviously a personal choice as to how you want to live your life and what you can afford. The second one is savings. And within that category, I would include government currency, which is the one we're all used to for maybe the whole of our lives, gold and Bitcoin. And then investments, which is the difference between savings, which are forms of money, and investment is that with investment you are handing over your money you're taking on some counterparty risk, but you expect to be paid for taking that risk. And of course there's a whole range of other risks within investing depending what you're looking at. So that's the essential structure as I see it. And historically, the only real choice, at least for the last few decades, has been government currency within that savings bucket. And that's very destructive because it loses value every year, we're consciously or subconsciously forced to think about not having too much in that bucket. So the 3 to 6 months that you referred to there, Alex, and moving whatever would naturally be within that savings bucket into either the lifestyle, so spending money on stuff we don't really want or need. I think we see that all around us. Or investing in stuff we don't really understand. And so I think the way that most people should be coming at this is, from a savings point of view, is if you've got a better savings vehicle, then actually for the vast majority of people, the vast majority of time, that's probably all they should do, just save in a money that appreciates over time. And then for some people, it will also be relevant to then invest, and we'll get into some of that as we go through, I'm sure.
On the question of cash, there is this, there's kind of this false notion, you hinted at it a little bit, that cash is safe. We've seen so much inflation in the United States in the last few years that it has proven that cash is sometimes less safe than putting your money into real assets. And that could be equities, and it could be other things that people think of as real assets, whether commodities, real estate, etc. So I think that is one aspect to think about when you think about cash. You're not just safer just because I'm saving, and I call saving cash, or a money market fund often is what people use for that. I would also say that if you're in a room with the kind of people that we are today, it's how much you put in, what your risk profile is. It's so individual. And I think that the kind of models that, Alex, you're referring to here, there are calculations that you can find of how much you should save, the savings, the recommended savings. It assumes that a person has not only a passive investment approach, but also passive living approach. You have one job, you have one income, you can assume that the income increases with inflation plus some percentage, and after that you can derive exact amount. Guess what? Most people in this room does not have that life. Incomes come and go. You go for years maybe without any income. So I think part of what people get wrong is to think of it as just what's my risk profile, and there's like this big dial out there. I think of it as more, what's your time horizon? If you are looking to buy something very soon, you do have to start accumulating the cash that you're looking to use for that, for example. If you're also looking for shorter term returns, you might actually want to be more active and do more both kind of value-based investing, but also like tactical that is not value-based. So those, I think that's like more useful framework to think about also the savings versus investment.
I'd like to add a totally different aspect to this, to just build on what you already said. And knowing half of you are Germans, and probably many of you live in Western welfare states. So I moved abroad offshore 27 years ago at the age of 23, and I basically, like Christoph Heuermann, I sort of have never really paid taxes in my life. And the other thing I've never had was that I never had governments tell me how I can invest and in what I can invest. And it drives me potty when I listen to people who say, oh, like my ISA and my pension fund and these restrictions and that, and I can't do that. And all I can say is, guys, move abroad, move somewhere offshore where you have the liberty to invest how you like and without having to spend half your day thinking about taxes and regulations and these things. And you can just focus on maximizing your returns, protecting your assets, building your wealth. It's extremely liberating once you've arrived at that point that you can just really focus on what is best for you rather than to be boxed in and bogged down by government regulations. So, leave basically is my message.
Thanks very Thanks very much, Sven. In doing that, in leaving, one of the things that you will face is various currencies around the world. Lotte, you've spent a career really analyzing from a macroeconomic perspective various currencies, and I'd like to start with you and then have your other panelists weigh in. I think there's some sort of a false assumption, particularly with the people in this type of room, and I'm subject to it myself, that all fiat currencies are trash. We need to get out of all of them. They're not worth anything. Go all in Bitcoin, all in on real estate, all in on gold. That said, we heard yesterday as well, Venezuela's been through a hyperinflation. The U.S. has historically been relatively low in inflation. It's picked up the last years. Mikkel Thorup mentioned a few of the countries that he's working in that have quite low inflation. So it doesn't seem that all of them are necessarily equal in this regard. I'd love to hear a little bit about how you analyze currencies. What are you looking for? How do you manage that sort of risk when you're thinking about an allocation? and sort of what are the factors that you're looking at?
Sure, I do macro investing on a fundamental basis, meaning I actually look at the values of something and then it's very simple. You take a position if something is undervalued and you go short if something is overvalued. And most people do not believe this when I say it, but currencies definitely have fundamental values and you can analyze them such. So when I take position in currency, I look at I do look at inflation, but you really have to can focus mostly on past inflation and see what is kind of the equilibrium exchange rate, and then you look at what carry I'm going to get to hold this position, and you take it from there. I think the important things with currency is that people often have two very extreme and both wrong views on currency, which is either take any currency exposures because in the end currencies even out. In the end we're all dead, but that's okay. Others say, do not take any currency position, hedge everything out. Now, the way that I analyze currencies and in the context of assets is that when you look at an asset, you should always look at it at a hedge basis. You want to think about, and if you don't do that, and if you want to take the currency into account, you have to think about your time horizon. If your time horizon is short, the currency will, in most cases, drive your performance. So if you're going to take a position where you're not going to hedge out the currency, you have to think, okay, what is my view on the currency in this country? And when I say a position, I mean international position, that you want to invest in the country. Okay, I love Argentina right now. Okay, great. You can think about what the currency exposure is. That's a bad example because right now you basically can't short the peso, as been true for a long time. But that's the way I think it might sound difficult, but it's helpful to kind of parse those things out. Do I like this because of the actual asset? Or do I like it because of the currency? And if I have to put them together, then you kind of have to weigh them against each other. So often you hear investors saying, I take a position only if they're both in the same direction. Okay, great, that's safe. But sometimes one direction is really big, the really positive one, for example. And then there's a little negative part of your currency analysis. And you should definitely take that position. It's okay if you use currency, just as long as you know kind of what's going on. When we think about currency, right, we talked about cash. There are very popular models in finance, right, that basically assumes that everybody has cash on the one hand and the same kind of portfolio on the other, and then it's just a balance between those. Now, those kind of models assumes that there is what's called a risk-free rate. So risk-free asset somewhere that you can hold, which is cash, which is treasuries. But as we've been talking about, there are really no risk-free rates out there. The best you can do, right, when it comes to the currency exposure is to think about what is my consumption going to be in, and that's what you have to have as your base. I would just call it a base rather than the risk-free rate, though.
So a couple of points to add to that. So one is because our clients are institutions, and institutions tend to be particularly good at thinking about what liabilities they've got to pay out, not just the assets that they're holding. And some of those liabilities are very well defined. There may be, there may be a specific formula that it follows, or something like that. And so those liabilities are denominated in a certain currency. And so a big factor that they're thinking about is what currency risk are we taking within our assets, and are we matching against our liabilities, or are we purposefully taking a mismatched risk? So it's that sort of what is their low risk position is something that's aligned with their liabilities, which could stretch out decades. The other point I was going to add was this: you talked about cash is like or maybe short-term treasuries, or is the risk-free rate. Yeah, it is at the moment. It doesn't mean it will be forever. And actually, if you sort of go back to my, the savings bucket, that's money. That is your risk-free rate, effectively. Now, depending on whether you view the world through a dollar lens, or a particular fiat currency lens, or a gold lens, or a Bitcoin lens, what are you denominating your performance in other words? That is what really determines your risk-free rate.
Right. So I'll deviate again slightly from the question because of the name of the panel, Capital Flight, and take your money where it's treated best. So I'm a bit of a dinosaur in the sense that I invest in equities, not real estate, not crypto, none of these things. And the best equity investors I know basically don't care much about the currencies. They focus on picking the right companies to invest in, and then over time the currency movements generally even themselves out. But what I would say, so you can also just simply say you ignore the whole subject, but what I would say and what I would give as a strong and passionate piece of advice is that we've lived in an era now in the last couple of decades of freedom of movement of capital, and that wasn't always the case until the 70s. For some countries, the 80s, there were capital controls in place. I live in Guernsey, where huge amounts of money are from South Africa. 10% of the population is from South Africa because these guys down there have had capital controls for decades, and Guernsey was one of the places where they could get away to. And I wouldn't be surprised if at some point in the foreseeable future we saw capital controls again in countries where you might not expect that right now. And then you really want to be diversified already with having bank accounts in different countries, in different geopolitical blocks, so that you can diversify your currency exposure and you're not completely boxed in by a country that says you have to keep your money here or otherwise you face huge exit taxes or you can't take it out altogether. So keep that in mind when you plan your investments and your diversification.
I think it's certainly a great point to make that capital only flows where it can actually leave extremely quickly and easily. To the extent there are capital controls, it's very difficult. People can move capital in. Typically, that's not where the control is. But no one wants to because they can't get it out. That's one big factor in the question of where is capital flowing. Sven, you have sort of notoriously span the whole globe in terms of investment opportunities, and this ranges from small jurisdictions, relatively fiscally sane jurisdictions such as the Channel Islands. You've also been relatively public about your admiration for the United States as a big-time capital market where lots of money and productivity is also flowing to. I don't think it would be too much of a surprise to say that it is a fiscally insane place, from a federal government perspective, but nonetheless, of course, money is still flowing to the United States in droves. And so I'd love to hear, what are the other factors that you are looking at? In particular, you can comment on the Channel Islands and the U.S. in particular, and then I'd love to hear the other panelists talk about sort of more general factors about why is capital moving to certain places and why is it moving away from others? Just like Titus maybe talked about earlier or yesterday, why are people moving away from certain jurisdictions and to other jurisdictions? But the same question, I guess, for capital.
That's a lot of things. I'll try to squeeze in 2 or 3 aspects here. So with the United States, much as it's a fiscal hell in many ways, it's just a very large market. And as I always say, if your salary is 10 times higher than in Europe, then it doesn't matter if you pay 41% taxes in New York because you still come out, a lot better. And for especially for young people, I would seriously consider the United States also because there are a lot of tax loopholes in the United States for building wealth. A lot can be done over there. But in terms of capital, going where it's treated best or where it's got the best return potentials, I'd say it changes a lot over times. And what I always recommend everyone does is get a banking relationship or a brokerage account where you can easily invest money across the globe because these opportunities shift. And we've now had 20 years of the United States outperforming in terms of the equity markets. A fun stat that I always like to quote is that in the 8 decades since the end of the Second World War, the United States equities outperformed in 4 decades and international equities outperformed in the other 4 decades. So it's not like the United States is guaranteed to always provide the best returns. So get a brokerage account with something like, for example, Swissquote in Switzerland, which is an online broker, or Interactive Brokers, just so that you can truly invest globally without any restrictions. And I think then you're set for maximizing your opportunities wherever they are.
And I would make the distinction too between what you were talking before, Sven, about leave, meaning putting your money to be invested from somewhere and diversifying that way, and the diversification that happens when you have your, say, Fidelity account and then you're investing broadly in broad market indices. The latter being, of course, much easier to do. Anyone can do it. when it comes to where the money goes, I do think that there's a way to look at the world from like a value-based lens. Often when people look around the world, they're looking a lot on what I would call tactical investment. And just to make that distinction is, if you're thinking about a short-term change, you're not thinking about the actual value. You're thinking about why things might change in the short term from sentiments, from people trading, that kind of thing. It's not only your meme stocks. It could be like geopolitics, and people who ask about macro often think about, oh, so what's going to happen in that election, or is Russia going to attack Ukraine, and things like that. That really does matter in the end, but that's not actually where what I would say that value lies. So I would agree that most people do not sit down and make the valuations themselves. I do think that you may consider the opportunities that are out there to do value-based investing from managers who do this, because it's not really that complicated, and it's a pretty solid way of investing. Meaning this, price goes up, you sell, and that's usually kind of how it works. It's not more rocket science than that. Often people think that investing has to be either very passive or extremely fast-paced, which is often not the case either.
So go back to what you said at the start of the question, Alex. The phrase I quite like is the best way to keep someone in the room is to leave the door open. And I think we're going to see that more and more in real life over the next years. I guess the point I'd like to add is that, and I really, it's talked about intermittently, but I really don't think it's given enough attention, is what are you measuring your performance in? What are you denominating your performance in? Are you denominating it in the local government currency, or the US dollar, or the value of the future liabilities from that, that particular needs to be paid from that pool of assets? Are you denominating gold or Bitcoin, of course? Are you denominating it or measuring performance relative to a global equity index? And of course, then which global equity index? And so it's actually a very complicated and should be a deep conversation and discussion with whoever the decision makers are as to what is your objective here? What is your low risk position? So if you look at active equity managers, global active equity managers, their low risk position is to buy the index in which they're measured against. Well, that's great. Maybe that works for them, but does it work for you? Maybe it does, maybe it doesn't. So I really do think that needs more. I mean, and it's a personal decision, either personal or for each institution.
Lotta, we spent a little bit of time yesterday talking about this question of where does a company or an investment opportunity domicile versus where does it then deploy its capital. Famously, companies in the United States almost always set up and register in Delaware. They're not always doing business in Delaware. Why is this? I mean, is this because capital is sticky? Is it just because that's what people have always done? Is there genuine reasons for it? Is there any way that this ever changes? Should it change?
If you're born in any jurisdiction like the United States, it costs a lot of money to move your money out of there. So I do talk to Sven about it, but I do know from people I know it's definitely a big path dependency there. The world is not one where you can just decide that I'm going to have my money over here. It does cost easily up to $100,000 to move a large amount of money to another jurisdiction. What was the first part of your question?
Why is it that U.S. companies typically domicile in Delaware, and even international companies often set up domiciliation in the U.S. and then deploy in Latin America, for example?
There's certainly a big tradition around where you put your money, where you start a company. You mentioned Delaware. A lot of companies get started in Delaware, meaning you're registered in Delaware. There's no people there, right? It's just you have to be registered somewhere. And what the meaning of being registered is, when there is a dispute, you know what courts you're going to. It's going to be those state laws and those courts. Often it won't matter because you're not going to do things that get you in disputes, depending on kind of industry. And there are industries where people get sued all the time, of course. And so I would say it doesn't actually really matter because of the cases. It's not that one lawyers are much smarter in Delaware or something like that. It really is a matter of trust. And often when you start a company, you're going to raise money, and most investors are very conservative, and they're going to look at where you registered. And if they see Delaware, they're like, I've done Delaware before. That feels good. And if they see it's Wyoming, they're like, hey, why? So there are several of these layers that you think one would break, where it's like, come on, you don't have to do Delaware. It's expensive. It's like not that good. And we've seen like cases that we might not approve of the outcomes of which, right? But still, that's very much it. It's stickiness is a good word for it. It's just a tradition where there's a game kind of going on when everybody derives from what the other person that you're depending on is going to think about where you registered, unfortunately.
Sven, you invest in companies all over the world that aren't domiciled in Delaware. Why is this? What are you perceiving? What do you think? Do you see this risk, or you just don't? You think it's overvalued, and therefore you're more comfortable elsewhere? How do you think through that question?
Well, two things really very briefly, given that we have limited time. I think jurisdictional risk is generally overrated. Most countries are largely the same. You can say they're equally shitty or equally good. It doesn't make that much of a difference. What I look for is liquidity. I want to be invested in things where I can press a button that says sell and I'm out, which is why I personally love equity markets, because unlike with VC or PE, you can just sell when you change your mind, and that's a huge safety mechanism.
So to bring it sort of back to the topic of this, and also hark back to Titus's talk yesterday, normally it's easier to move money to somewhere else where it's treated better than it is to move your physical self. There's friends, family, work, there could be all kinds of things which are tying you to where you currently live. And we see that already with the large investment fund managers typically have their funds registered in the Channel Islands, Luxembourg, Cayman Islands, Ireland. So they've already made moves, and these are decades ago really that they've done that. So so moving your money should be easier than moving your physical self. So maybe that's a good place to start.
I think I just got a message. We have about 2 more minutes, so one final round I'd like to go through. Tying this to the Free Cities Conference, some of the efforts that we've seen, what is it that Free City developers can do to make their jurisdiction the most attractive, to try to get capital flow in easily so that it's cheap and abundant for entrepreneurs to start businesses? What are the best few things they can do in a few words? We'll start with Sven and work our way down.
Offer an easy possibility to open a bank account, because opening bank accounts has become so difficult the world over that we need an alternative to that.
And then you set up the legal system where you end up having cases and you create the record of those cases. It takes a long time for most people to trust a place. So you're just going to have to get started, and it will grow with time. But there is no quick fix to people to actually trust the legal system in any place.
Yeah, I think it's stability and certainty, which is what's going to give people that trust, that confidence.
I thought you might say also working on a Bitcoin standard.
Well, that would also help.
Well, thank you very much. I appreciate my fellow panelists' time. Thank you all.